Scott Stewart, CEO, Insol International, based in Chicago and London, and Seth R. Freeman, Senior Managing Director of GlassRatner Advisory and Capital Group. Thank you so much, both of you, for joining us.
Thank you.
It's a critical time. It's great having both of you. Seth, let me start with you. With regard to the global macro setup and everything that's playing out in geopolitics, how are you seeing this sort of global chessboard play out?
Well, it's a moving chessboard, especially given the ongoing chaos that Donald Trump is causing. And not only in terms of markets, but the world order possibly changing. And it's the biggest concern I have is this going to be permanent, or will things go back to the normal that we used to think of as being normal?
And will it?
It's a little early. We need to see a little more cohesion among the opposition party, you could say.
Sure. Scott, your take?
I think globally, economic fundamentals are strong, but to Seth's point, where chaos is kind of dictating the environment right now, unfortunately, the new norm seems to be settling into chaos, but fortunately, there's nothing fundamentally in world economies that's demonstrating or pointing to a severe downturn. Consumer confidence seems to remain high. Inflation seems to be stable throughout the world. The employment picture seems to be very positive. Here in India, you're on a wonderful trajectory of economic growth.
Right.
That continues to just define the planet right now. So yes, chaos because of the American political landscape and how that's affecting the geopolitical environment. Definitely something that we have to keep an eye on. But I think people have settled into that as kind of a normalcy and are working around that as it kind of exists with, fortunately, an otherwise good economic environment.
So Stuart, how do companies navigate this uncertainty? Because this is some of the most uncertain things, not many boardrooms are able to manage this kind of uncertainty. So how do companies navigate it?
I think that's a terrific question. The tariff issue is the best example. So tariffs were dealt with in the early goings by hedging against them and protecting against them, buying inventory early, making sure inventory was warehoused both overseas and in the United States. Now we're at a tipping point. It's going to be a very interesting rest of the year where the protections that have shielded consumers against the tariffs no longer are going to exist. But the quiet factor that people are starting to see now around the world is AI, which has driven markets in a very positive way, is starting a slow consolidation, which is very normal. But it could convalesce at the same time that you're going to start to see the negative effects of tariffs. So if that starts to happen, the markets might look a lot different. So directly to your question of how companies are going to navigate that, they have to understand that the chaos is going to continue. The tariff issue isn't going to go away, and there's going to be some market consolidation. So to model is still difficult, but I think there's some predictability in the fact that there's going to be prices that are going to be negatively affected, particularly as the tariff issue now starts to shine through in a more meaningful way.
Said 2025, Donald Trump was the narrative everywhere. I mean, do you see that moving into 2026 as well? It's at least the first half of January shows that.
Yeah, he's not slowing down in the least. And further, in terms of Scott's comments, the risk is going to be change in sentiment, because even if the world is functioning, sentiment both on the investor side, but also on the consumer side. And in the United States, many consumers are tapped out on their credit cards. The used car market is seeing a tremendous amount of defaults, which is impacting those banks that focus on subprime credit and so forth. And the consumer market can be fickle. And that's where I think the real risk is.
But Seth, it seems like the US market has been absorbing the shocks coming from Trump rather well, barring a few days of negativity. You did speak about credit cards, and that's going to be another issue in the US right now because he's proposing for those spends to be capped at 10%.
Right.
What kind of an impact are you expecting? Is it going to be very detrimental?
It's going to be detrimental to consumers. Not, it's going to be hard for the banks. But the bank's reaction is if their interest rates are capped at 10%, is they're just not going to issue credit cards. And there's a big piece of the US consumer market that really needs their credit. And banks and credit card issuers do customarily factor in a sizable loss factor. And 10% is going to make it completely unprofitable.
Scott, how should banks hedge in an environment like that? Is there any form in which banks will hedge? Is there any form in which Trump will still come out, Trumps if I can call it, and push lending at 10% on credit cards?
Let me pick up on Seth's point. Credit card companies will not issue credit cards. And the most important point that Seth made, and I wholly agree with, consumer confidence drives everything. So if consumer confidence is lost, there isn't credit available, which is tremendous in the United States and which drives consumer confidence and the ability to purchase. If that is reduced and there isn't credit available at the lower ends of the consumer market, then you do shake your economy to its very core. And you've probably heard this expression a lot. It's the economy, stupid. That affects politics. And this is a critical year in American politics with midterm elections coming up. So decisions that get made this year very much might impact what happens next November. And if what happens next November is that there's a transition in the legislative branch of the United States and the Congress, that could change the tide of what economic stability and worldwide economics looks like, both with President Trump still in charge, but with potentially a different Congress, and the dynamics then changes dramatically. So there's a lot in play right now.
But Scott, sorry, a quick follow-up. Markets have completely brushed this off, both from a consumer standpoint as well as from what it means for lenders, because it will mean substantially lower credit. Repayments will come through, and credit won't get pushed out. So on both those factors, we've not seen an impact in U.S. markets at all. Is it not getting priced in?
So let me tell you what you are seeing in U.S. markets. You're seeing the withdrawal of foreign investment in U.S. markets because there's a loss of confidence in the U.S. markets. So the concern of instability and the fear of what might come actually exists, and you're seeing that from the exit of a lot of foreign investment dollars. That's a red flag. How things like interest rates play out is critical. How the credit card situation plays out is critical. And if this starts to affect purchasing, development, manufacturing, building, investment opportunities, housing, all of those things could shake, but we're not going to necessarily know or see the effects. And as I go back to my earlier comment, because we're settling into an environment of chaos, we accept that what's said today might be different tomorrow, and what happens tomorrow may not echo what was presented today. So there's no model or roadmap to be able to follow other than to watch, take a breath, and wait till tomorrow.
Said, the entire Trump policy, it seems to be focused on the American public. If consumption, consumer confidence, and other issues are going to be the key material for the midterm elections which are coming in, do you see more of that global turmoil and global geopolitical risk coming into the markets?
Again, I think it just creates a volatile sentiment situation. And there's one important factor, and we used to see this even more in India in terms of foreign. Every day the news was about foreign fund flows, right? For money, the money markets, the institutional investors can move money on a dime, large amounts. There's a lot of liquidity, and there is a real risk that some people in Manhattan are going to wake up in the morning, and the risk committee is going to say, we have to do X, or from London in particular, or from Switzerland. And there's going to be a limit, I think, into how much institutional investors can withstand, because businesses and investors need to do planning, and they're also managing portfolio risk at the same time. It's very hard to think about having to adjust your weightings in Japanese bonds or U.S. Treasuries and so forth. And it just makes it way more difficult for investors. And that's going to trickle down to the on-the-ground economy.
So on that note, Seth, where are you seeing foreign funds flowing in 2026, given everything that's happening in the US? You have the entire Russia-Ukraine rhetoric playing out, US versus NATO, that is at play. Japan's not looking good right now. Where does India fare in all of this?
Well, it's really incredible if you look at what happened in the last quarter of fourth quarter. The flows to emerging markets and to India were incredible. The returns for people in EM funds finally were getting highly rewarded. And I actually think that in terms of relative growth rates, that you're going to see more money coming in to emerging markets, which is positive for India. There's a lot of basket investing, index investing, and to the extent India's included in a certain fund, it's going to benefit, besides direct investments.
Do you see the next few months going to be a little volatile for global markets, especially because you have a new Fed chairman who's going to be appointed, and and Trump is going to push through rate cuts despite a sticky inflation in the U.S.?
I think we're going to not see anything dramatic, but I do think CEOs and fund managers are really going to be watching very closely. The world watches the United States, and we can see what's happening at the World Economic Forum, for example, this week. And if the Fed chairman is going to have to really balance being a Trump appointee and pretty much the historic independence of the Fed, I think it's going to be actually a very hard job for that individual.
Scott, how are you looking at India? And I'll shift focus to India because global markets to a large extent do impact India, but India has been in a zone of its own, as one could say. Returns have been tough to come, and especially dollar returns, and that's kept FIIs away to a large extent. Give us your take on how you as an FII think of India now at this juncture.
India is uniquely situated because of the growth trajectory of the country and the fact that India has become a focus worldwide, because the growth trajectory still looks as if by 2034 it will overtake China as the world's leading economy. So as that continues, you're going to get a lot more focus on investment opportunities and growth in the business sector here. And with that, you're already seeing a lot more foreign dollars come in. So I wouldn't be concerned about what's happening short term, because the long-term prospect is green lights all the way. And I think if the growth trajectory continues, and so far it's met goals and it's exceeding goals, there's every reason to believe that the trajectory going forward is going to pay very positive returns for a good long time to come.
Then, Seth, why is FI holding at an all-time low in India, or a decadal low? Apologize, I changed that. A decadal low in India. We're at 16% in terms of FI holdings. They've traditionally held much more than 20%. And every sell that FIIs make are, of course, being lapped up by DIIs. So when FIs are seeing that, how do you rationalize it? Because you've got such strong DII flows. Why would FIIs therefore keep selling?
It goes back to the fact that the U.S. and other markets really had high growth. And that's for the same reason we saw a lot of money going into EM at the fourth quarter. It's relative growth, relative returns. It's very risky for U.S. investors to invest in the Indian market when the rupee takes a hit, because you end up having this sort of double whammy effect, having been in this market for over 20 years now, where you've got a rupee devaluation and the market going down. Right. And that concerns investors. A lot of money, I think, that would have been going into the market has gone. There's been other kinds of money. So I think we have to look at the PE funds that have come in, and the money generated by this batch of very successful domestic PE funds have raised a lot of foreign capital. So it may not really be in the market, in the public market, but a lot of money has come into India.
Scott, the next big event to watch out for in India is going to be the union budget. We're just days away from it. Lots has been done to boost consumption already. If you've been following the consumption space here, the GST cuts have helped consumption this time around. The tax cut in the budget last time also. Are you expecting to hear anything major? And what could be the impact of this Indian budget announcement on the global level?
I think politically, you're going to see a lot more stability, midline stability. I don't think you're going to see anything particularly radical or earth-shaking in that. Now's not the time to do that. And since the fundamentals kind of speak to both current stability and expected growth, even if it's modest growth and not immediacy in returns, there's no reason to believe that there's going to be shockwaves that are going to come through the market when the budget's presented. I don't see it at all.
Okay, so stability basically in the market.
Yep.
Seth, your view on the budget?
You know, I remember during the I was on TV during the budget commenting, and we had our funds operating, and the announcement was to impose capital gains tax.
Yeah.
And that was a point where everything was going great, and the finance minister was on, and we had this shake-up in the whole confidence in the marketplace. If something like that happens, that would be detrimental. But I think that the government's learned a lot of lessons from that experience.
No, sure, but an easing of that provision, would that unwind some bit of FI confidence?
Yes, it would be great actually if there were some policies specifically designed, because this still requires a lot of long-term investment for infrastructure. I mean, the tube is unbelievable here. So anything that would make it easier to invest in India is helpful.
Scott, gold, silver. It's beaten the best fund managers globally. What next?
I think as chaos continues, gold will continue to go up. I mean, that's really the simple answer, because gold is being driven by the uncertainty around the chaotic environment that's largely been caused by the United States. And every day you open up the financial papers and you see gold up, silver up, gold up, silver up. Silver, of course, is also tied to technology. So yeah, there's some actually rhyme or reason there. Gold, however, people are just doing what they've done traditionally in uncertain economic cycles. And what's interesting is this isn't an uncertain economic cycle. It's an economic cycle defined by chaos. So the uncertainty is driving people into gold because gold is certain stability. And I think that's going to continue as long as the chaotic environment which the Trump administration perpetuates continues.
Just before we wrap up very quickly, now that we've spoken about gold, I want to connect that with China. The kind of gold reserves they have. US has been targeting China with tariffs, but right now US's tussle is with NATO right now. Mm-hmm. You know, China is largely unaffected. Is that going to emerge as the dark horse this year? Is China somewhere that you're really focusing?
Well, the Trump administration and Trump has really not focused, as you suggest, more recently on China. And the setup last year or the last few years, was really going to be beneficial to India politically because of all the negativity towards China. And actually, I think that we're going to see, and the impact on U.S. consumers so far, and broadly in terms of imports, hasn't been as great as expected from the tariffs. But I don't think we're going to see China like before.
Scott, one last question. The rupee depreciation has played out. Oil prices are at reasonable levels. A lot of the negatives in oil prices too are not impacting oil prices in significant fashion. Is 2026 the year in which FIs relook at India in a significant fashion and India outperforms rest of EM in your opinion?
Good question, and I don't think there's really a clear answer on that. When you talk about the oil markets are also not showing terrible instability. And then, of course, what happened with the United States and Venezuela, an entirely different situation where we're looking at trying to take on the oil markets in earnest, But the oil markets haven't reacted in a negative way, and there's no fundamentals that are showing that much is going to change in those markets in the coming year.
Scott, Seth, it's been an absolute pleasure, and it's been even better because it's been in person. So we've been able to have a very, very candid chat. So thank you so much for coming in and giving us that perspective. But that's the FI view, viewers.